Boom. All right. So talking about deciding the right options for your strategy, we were diving into the Greeks. Hit like and subscribe if you're on YouTube. I always forget that one, but I was going to buy this indie call and they got earnings tonight. So I have a nice chunk of $10 calls for next month, and I'm up 100% of them, I think. So I'm like, I gotta take profits here, but I don't want to miss any more upside. With earnings being tonight, they could crush it. At the same time, even if they crush it, it could still drop the stock to nothing. So there could always be a sell-off after earnings. It's just how people are, or how the market is, I guess. So I want to add to my 1250 call position because it's much cheaper and it'll give me more exposure, and then I can take some off the table without worrying that I'm going to miss a huge rocket ship to freaking $20 or something, because it's the first time they're reporting earnings. A lot of speculation that they're going to blow it away, but you never know. So when I go here and I click on the limit price bid ask spread, and then I go down to the Greeks here, we went over delta in the last video. So delta is the rate of change in the option for every dollar that the underlying changes. And now we're on to the next one, which is gamma. Gamma measures the rate of change of delta. So this is where it starts getting a little more complicated. But for every $1 that the underlying moves, so right now Indy is 10.56. If it goes to 11.56, my option would be worth 22 more cents because of delta per share, because it's an option. But then the delta of that option would go up almost 15 cents. We're around. So then the new delta would be 37 cents. So once the underlying Indy has gone up $1, so it's 11.50 instead of 10.50. My options contract is going to be worth 22 cents more, and the delta on that contract is going to be 37.37. And you'll see they're changing right now. So these change all the time. So this just really helps you calculate, especially on bigger options too. If it's going up $1 every day, or $2 every day, or 1% every day, or however you want to calculate it, you can kind of have an understanding of how that's going to progress and how quickly your option is going to be profitable for you, or in the money, or whatever. Actually, it has nothing to do with being in the money. But once it's in the money, the delta goes up and the gamma goes up as well. That's just kind of a natural progression if you're talking about calls. So gamma measures the rate of change of delta. Delta measures the rate of change of the option for every $1 that the underlying, which is the stock that the option is on, moves. Okay? I know this stuff can be confusing, so please, if you have any questions, drop them in the comments below. Let me know. I'm happy to answer. I'm happy to help.